Welcome to Retirement GPS, navigated by Zynergy, your roadmap to a secure and confident retirement. Each week, we explore strategies, stories, and planning frameworks designed to help you navigate the complexities of life after work. From tax planning to investments, income strategies to risk management, our goal is to give you the clarity and confidence you need to make informed decisions. But retirement isn't just about the numbers. It's also about lifestyle, purpose, and peace of mind. We're here to guide you through both the financial details and the personal dimensions of this next chapter. Let's chart today's course.
Welcome to episode 20 of the Retirement GPS podcast. I'm your host, Ryan Zaharchek, certified financial planner and president of Zynergy Retirement Planning.
And I'm Zane Belsack, associate planner here at Zynergy.
And what we're going to talk about today is we are not too far from 2026. It's amazing how quickly 2025 is come and gone.
Time flies.
It flies, that's for sure. And we talked about goal setting recently for 2026. What I want to talk about today is 5 key strategies, 5 great strategies that you can implement right away going into 2026 to be ready to kick off the new year just with a bang. And these are strategies that we implement with our own people, and we make sure that everybody has a chance to go through early in the year. And we said, why not pass that along to our audience so that they can get a great start in 2026 and be raring to go from a financial standpoint. First and foremost, let's get started. Our first strategy for kicking off 2026 with a bang is start by laying out your Roth conversion strategy for 2026 early in the year. Now, when we talk about Roth conversions, we say we typically wait till later in the year to convert, and that is true. That is a true statement. However, we like to be prepared early in the year by doing preliminary Roth conversion calculations. Why do we do that? Just to familiarize yourself, Roth conversion is very simple. It's taking money from our pre-tax retirement account and converting it to a Roth IRA. We are going to pay the tax now and have it done. And we now have it into an account where it'll be tax-free, grow completely tax-free for the rest of our lives. It'll avoid required minimum distributions and keep our brackets lower later in retirement. So having that diversification is really important. Again, we've done a whole podcast on Roth conversions, so I'm not going to get into the conversion strategy much more than a high level. But we typically talk about let's do our calculations at the end of the year. Let's do our conversions at the end of the year. Why? Because we know what our income is. And when we have more clarity on our income, we can convert really, I don't want to say to the penny, but within a couple of dollars of being really sure what our income is. If we do it early in the year, there may be any number of things that change. We might get a raise. We might get a bonus. We might hit the jackpot at Atlantic City. Zane, did you hit a jackpot at Atlantic City this year?
I wish. That would be great.
That would blow your Roth conversion strategy out the door if you don't get that. Anything could happen that would affect your taxable income that you don't see coming and could really throw off your calculations on a Roth conversion. However, if we do a rough Roth conversion earlier in the year, one of the best times to do a Roth conversion, yes, is late in the year because we know the income, but probably even better time to do a Roth conversion is when the market corrects and corrects dramatically. Now, explain that. What do I mean by market corrects and corrects dramatically? Looking at 2025, we had a pretty significant market correction. It was in April of this year. After tariffs were announced, the market corrected about 20% in a very, very short period of time, a few weeks. And during that time, if you have your Roth conversion numbers done, you may want to trigger some level of Roth conversion during a correction of that magnitude. Why? Let's just use a simple example. Let's say that I have 100 shares of Apple stock trading at $100 a share in my pre-tax retirement account, right? If I were to convert that today, I would do a $10,000 conversion. A $10,000 conversion would trigger $10,000 in income that I then have to pay taxes on. It could be a pretty hefty bill. Now, what if there's a 20% correction in my Apple stock and Apple falls from 100 to 80 and now I convert? My conversion is now only an $8,000 conversion and not a $10,000 conversion. But do I have more or less shares of stock in Roth, whether I converted when the stock was high or the stock was low? And the answer is the same. We're getting the exact same thing. We're moving the exact same number of shares over from one account to the other. It's just less dollars. Or even better, we can move more shares for the same dollars. So if we're converting Something like, and by the way, I'm not encouraging you to have Apple stock in your pre-tax account and convert it to Roth. It's simply an example. But if we have the S&P 500, if we have an international fund, if we have a bond fund, any one of these things that are moving, and specifically if we convert them when their prices are low, we're converting the same or more shares for either less or the same value.
So when do you think there's going to be a correction? Do you have your crystal ball with you?
My crystal ball broke years ago. Actually, I never really had a crystal ball, even though I like to say it. When do I think the next correction will be is anybody's guess. So I really don't know, nor do I really care. It's the equivalent. I like to say I'm like a sailor out on the sea, and I've got passengers in my boat who are trying to get across the ocean. And the passengers are asking me, which way is the wind going to blow in a day or two or three? And my answer is, I don't know and I don't care, because when the wind changes direction or blows in a different way, we change our sails, and we have strategies for when there's market corrections, and we have strategies for when the market's good, and not necessarily designed to protect through those periods, but designed to take advantage of those periods. Converting during a market correction is one of those strategies. It's not going to all of a sudden reverse your portfolio to now be worth a lot more like pre-correction values. However, we're taking advantage of a great tax strategy while the market is down. We might do a rebalance and buy more stocks and sell bonds while the market is low. These are the types of strategies that allow us to change our sails when the wind changes direction. But I have no interest in predicting the wind. The sailor has no interest in predicting which way it will blow tomorrow or the next day.
See, I like that strategy. It's really just being ready for anything and taking advantage of something that really is you would say a bad thing. A correction is a bad thing nonetheless. But taking advantage of that and using that to your advantage is great.
And I hate to use gambling analogies because people get frustrated or worked up when I use gambling analogies in investing, because I don't see it as gambling, but I do see it as we're card counters at the blackjack table. We don't know what the next card is going to be, but we know the odds will always be in our favor, and we have strategies to take advantage of good cards and strategies to take advantage of bad cards, and that's all we can do because we don't know what the next card will be. Rule of thumb tip here is look at what is the RMD that I might want to convert this year. And that may be 30 or 40,000. You can even use the number you used last year, assuming that you expect things to be roughly the same. So if I have a $30,000 or $40,000 conversion I'm planning to do in 2026, and I'm going to wait till the end of the year just to confirm those numbers, but we do get that correction. We do get a, say, 20% plus correction. And the question may be, where is enough of a correction to make it worthwhile? I typically say about 20% is about that number. You can convert at 20%. You can wait till a bigger correction. Bigger corrections are really rare. But if we get a 20% correction, you can trigger a good chunk of that conversion. You don't have to convert the whole thing because you want to confirm that is the amount of money that, is the right conversion at the end of the year. But if it's 40,000 and you say, I think I'm going to convert 40,000 this year, the market corrects 25%, and you convert 30,000, you're doing a great job of taking advantage of a volatile market. So step one, make sure that you are laying out your Roth conversion strategy for 2026, at least preliminarily. Number two, if you are collecting RMDs, know what your RMD is. We did an RMD required minimum distribution podcast episode just recently, and that was really designed to help you calculate and figure out what your RMD is. If you're 73 or older and you're collecting required minimum distributions, you know what that number is as of December 31st. So really at the close of business December 31st, we'll just call it January 1st, you should know what your RMD is for the year. If you're working with Zynergy, we know. You can call us on January 2nd and we can tell you in 2026, your RMD is $25,000. So we have it laid out. We know what the number is. And then we can decide, how am I going to use it? So knowing what your RMD is for the year and then deciding how you're going to use it. Now, if you're already taking distributions that'll satisfy your RMD, then there's no problem. You really don't have to worry about this strategy. But if you're not, you might have a big vacation that you're planning. You might be questioning yourself, hey, can we really afford that Alaskan cruise we've always wanted to do? By knowing that you have an RMD coming at some point throughout the year, that you really don't maybe necessarily need the money or have thought about the money, now you can do your planning for 2026. Strategy number three, if you are still working, so if we're not RMD age, we're still working and we're contributing to our IRA or our 401k, make our contributions as early in the year as possible. This may not necessarily be true for a 401k, but definitely for an IRA. I can make a $7,000 IRA contribution. If I'm 50 or older, I can make an $8,000 IRA contribution. And the goal here is make that contribution early in the year. Don't wait till later. And why, Zane, do you think we would want to make our IRA contribution as early as possible?
Because you're missing out on that projected investment growth. Say you were to invest January 1st compared to maybe December 1st, you would be essentially losing all of that potential gains that you would have if you were invested.
Yeah, that's exactly right. Again, getting back to the card counter at the blackjack table analogy, if we know in general the market goes up over time, no guarantees, right? Nobody knows for sure what's going to happen, but in 7 out of 10 years, roughly, the market will go higher. So that's pretty good odds in my book that the market's going to go higher in any given year. No guarantees, and it really doesn't matter. It doesn't need to be guaranteed because we're putting the money away anyway. But if we put it away earlier in the year and the probabilities are the market's going to go up, we get effectively an extra year of compounding out of that contribution. And Zane used January 1st versus December 1st. I'll use January 1st versus December 31st, which is an entire year, 1 day short. You're literally losing a year of compounding. And it's not the year that you make the contribution that matters. It's the year on the back end that matters. That's always where compounding is the most powerful. So if I'm compounding money for 30 years, year one is really irrelevant. It's only relevant to the sense that it will give us an extra year. Instead of being year 29, now we're going to be year 30, and it's year 30 that's really powerful. So making that contribution January 1st or January 2nd versus December 30th or 31st gives us an extra full year of compounding. And to Zane's point, it could be 11 months. It could be 8 months. It could be 5 months. But all of that compounding is powerful. So make the contribution early. Don't try to time the market. A lot of people will tell me, I want to put my IRA contribution is, but I want to wait for a correction. Don't try to time the market. We did talk about a correction with a Roth conversion strategy. That's very different. And it's different because we have a lot of clarity at the end of the year on our income. With contributing to a long-term retirement account, trying to time the market is almost a fool's errand for sure, because you're just as likely to get a market correction where you're going to be able to buy at great prices as you are that we never get a pullback or a correction and you miss a 20% gain that year as the market goes straight up, which happens in many years.
The emphasis is in what you even said, long-term investing. It's a long-term investment. So it's difficult to time.
That's it. It's chipping away at gains. Let's look at strategy number 4. If you are retired and if you are taking distributions from your retirement account, look at last year's distribution rates. So one of the things that we will be talking about, we've talked about before, but we'll probably do a full podcast on, is distribution rates. How much can we take? And distribution rates are really important to understand because our goal is that we want to stay roughly between 4 and 5%. Now, this is not a hard and fast rule. It may be slightly different for different people. If you're delaying Social Security, maybe you want to push into 6 or 7% until Social Security kicks in. But the typical rule of thumb is we want to be 4 to 5% on our distribution rate. So if we want to be 4 to 5% on our distribution rate, come January, come February, we can take a look at what did we actually draw last year. Now, in our business, in Zynergy Retirement Planning, we actually give our members a breakdown of that number at the beginning of the year so they can see last year you drew 3%, or you drew 6%, or you drew 4.5%, right in the middle. And then we'll talk about it in our meeting in February to say, hey, did we distribute more than we should be? Are we putting our portfolio at risk over the long term because we're distributing too much? Or are we on track? And I have a conversation with probably about a third of my members to say, you're not taking as much as you can. Are you sure you don't want more money? Again, Zane, good problems to have by that conversation. I like that conversation.
Very good problems to have. Yeah, you'd rather have that conversation than you're taking way too much.
Yeah, that's for sure. And I always tell people, we finally got to the point where I want you to take more money and you're not taking enough. So let's figure that one out. But the point is that a good plan isn't just preservation, but it's purposeful spending, understanding what your distribution rates are and holding within those rates. And it is a good, again, topic for another time in a podcast that when it comes to our distribution rates, a lot of people will tell them we're going to distribute 4.5% over time. And then they reach out to us twice a year and say, oh, but I need this thing I forgot about, or I need to buy a car. And before they know it, they're now at 6 or 7%. So I don't really care how we take it, but we need to keep it within that range, 4 to 5%. So come the beginning of the year, take a look, make sure that you're staying in the range. Last strategy for the new year. And this is a kind of a pretty obvious one. You probably have heard it before, but rebalance your portfolio if needed. Is it time to rebalance? This one I'm actually going to encourage you to wait till February on. A lot of people do rebalancing in January. There is auto rebalance in portfolios typically that occur in January, which can create a lot of volatility. And specifically, they call it the January effect, specifically a market sell-off in January because of this sort of rebalance triggering. People don't want to sell things at the end of a year, especially in a good year, because they don't want to trigger taxes, but then they'll sell them at the beginning in January to rebalance and sell the things that were winners, but defer the taxes a year into the next year. And that creates a little bit of market volatility. Run a rebalance, but run it in February. We also say run a rebalance. If you have an automatic rebalance on your 401k or your IRA, that's great. Automatic rebalance is great. It takes it off your plate. You don't have to worry about it. But if you don't have an automatic rebalance, looking at it every year in February and saying, am I getting too far out of line? And let me just be clear about what is a rebalance for those of you who are new. A rebalance is if I have a simple portfolio of 50% stocks and 50% bonds, and the stock market does great, and because the stock market's doing so well, interest rates are going up, and the bond market doesn't do so great, and now I'm 60-40, that's wonderful that I did so well in my stock portion, but I'm getting out of balance, right? Because if that happens again the next year, and I'm 70-30, and then I'm 80-20, guess what's going to happen, Zane, when the market corrects?
You're not going to have a good time.
You're not going to have a good time. That's probably the best way I could describe it, is you are not going to have a good time. So let's just go with that terminology. Your good time is coming to an end because 80% of your portfolio may correct 50%. And that's a problem. And it's actually a problem that happened a lot during the tech bubble. People were just continuing to buy. They weren't rebalancing. And in fact, they were doubling down on the things that were doing well, large cap stocks, specifically technology stocks. And it just grew and grew. And guess what happened when large cap stocks corrected? The NASDAQ corrected 80%. Large cap stocks in general corrected about 55%. It was a massive correction over a 10-year period that a lot of people learned a very hard lesson about the importance of rebalancing a portfolio. So make sure that you're doing that at least once a year is what we say to people. Once a year is usually plenty. In Zynergy, we rebalance based on drift. So we don't go in there in February and rebalance everybody. What we do is we say, how far have they drifted? Right? So if you're 50-50 and we have a 10% drift on it, that means if anybody gets past 55%, we automatically rebalance them back to 50-50.
That's definitely something useful to know, especially rebalancing, not really based on timing, but based on drift, is something that I think our listeners can really take advantage of.
And these are all topics that we talk to our members about in our February meetings. So we do sit down with every single person we work with in February, and we talk through these topics just to make sure that they have an understanding of what they need to do and what they need to look at. So for you, what you should be doing, and you can wait till February on a lot of these, although I like the idea of doing the Roth IRA calculation right away, but sit down in January, February, and do a review of these 5 topics. And just to reiterate, explore your Roth conversion strategy, have a preliminary strategy ready to go in case there's a correction. Know what your RMDs are. So if you do have RMDs, if you're 73 or older, be prepared to take them this year. If you're still working, make your IRA contribution early. Make that IRA contribution early when you can. Review last year's distribution rate if you did take money out of your retirement accounts to make sure that you're living within 4 to 5%. And then, of course, rebalance your portfolio if needed. Confirm that this is all done and ready to go by the end of February, and you're setting yourself up for a fantastic year.
I also think it's just better to do these things in the beginning of the year because then you just get them out of the way.
Absolutely.
It's just so much better.
Yeah, and it doesn't mean you're done for the year. There's other things you should be doing throughout the year, but you get a big chunk of things done for sure. And when it comes Roth conversion time at the end of the year, when you're actually going to do a Roth conversion, because maybe there wasn't a good enough correction to make it worthwhile, well, that's a time then when you can sit down and really have a good understanding that I was planning to do 40,000. Let me run some actual numbers based on actual income, and now I can do 43,000, and that's what we convert. Ladies and gentlemen, thanks so much for being on. Again, if you like what you hear, if you like our podcast, make sure you actually like our podcast so that we get more viewers. Make sure you subscribe so it's coming automatically onto your phone every Tuesday. Every Tuesday we're dropping a new episode. We're dropping some new information, and we want you to hear it. We want you to be a part of it. And you just keep learning and you keep planning. You're getting there. Thanks so much. Have a great day.
Thank you for listening to Retirement GPS, navigated by Zynergy. To explore today's topic further, visit our blog mile markers at zynergyretirement.com/blog, where we offer detailed strategies, examples, and downloadable tools to support your retirement journey. Follow us on LinkedIn, Instagram, and Facebook at Zynergy Retirement Planning for weekly insights, checklists, and planning reminders. If you found this episode helpful, please subscribe, leave a 5-star review, and share it with someone planning for their future. Until next time, keep navigating toward a confident retirement. This podcast is for informational purposes only and is not intended as investment, legal, or tax advice. Listeners should consult their own financial, tax, and legal advisors before making any decisions. Zynergy Retirement Planning is a registered investment advisor located in Red Bank, New Jersey.